So we started the day today after having been down pretty heavily yesterday. We had a gap and go 2 days ago to the upside, right to trend, and we stopped right there and reversed yesterday. And then today we had some junky jobless claim numbers. As everyone knows, I am very, very bearish on the jobs market. I have been talking about automation and AI for quite some time. And I really don't know that I've heard Yellen discuss this before, but I have not heard it in a while. It was like last summer. I was in a car ride, and it was during one of her testimonies, and she was talking about. I just want to move this a little bit there. That's a little better. She was talking about technology. I don't think they quite realize that it is never coming back to the way it used to be. With the Obamacare mandate, which is a tax on businesses, with the tremendous advances and advantages of using automation and AI, it just seems to me very silly that people are going to think that hiring is going to take place. I know that Walmart and a lot of other companies have been raising their minimum wages. I mean, it's just getting more and more expensive to hire people, and cheaper to go with AI or automation. So I don't see how that's changing. Today you had some comments out of some of the newer FOMC members. This Loretta Mester, I believe her name is, and what's her name? Esther George, the two new ladies on the Fed. They are both out of their minds. Two very hawkish members. I don't know if they're just trying to get their spurs and sound like tough guys, or tough girls in this case, cowgirls in this case. But I don't really understand what they're talking about. They were talking about inflation is coming back into line, and the jobs numbers are getting better, and so on and so forth. I mean, if they are looking at a set of data that I don't have access to, that we all don't have access to, I really would like to see it, because Friday's jobs numbers were a miss, a big miss with revisions down. I talked about this in the last video. Jobless claims were up just as soon as today. The Atlanta Fed has been cutting their GDP expectations, and we have, none of the economic reads. The GDP numbers have been atrocious. I just don't know what they're looking at. If anything, they should be looking to be doing more accommodation, not hiking. So I think this was just some loose lip, tough talk from the newbies. That's sort of what I'm gonna label those two, the newbies. And I don't really read much more into that. I think what really matters is Yellen and probably Bullard. I think those are the two people that I listen to the most. I don't really Stan Fisher, I think, is also is a maniac, and I don't really understand what the other ones are, what they're talking about, what they're looking at, and what they're talking about. I mean, honestly, they're making themselves sound incompetent. The more they talk, the more incompetent they sound. So that to me is quite reckless. All right, so that covers the Fed, I think. Actually, there's a couple of more caveats I want to talk about with the Fed. So there's a lot of talk. I've heard some predictions. There's this guy on John McLaughlin. He's like the old guard. I listen to that show sometimes. He was saying his surprise prediction is a hike in June or July. In June, I think. The probability of a rate hike in June is 8%. I wouldn't exactly, bet the farm on that. July is 19%, September is 38%, November is 42%, and December is almost 60%. It's at 59%. I think if there's a probability of a rate hike, it seems to me like it would be in December. That's when they raised last year's. And what am I looking at? I'm looking at the CME group has a website, and they have this expectation. I will post that link in the, actually, you know what, I'm going to tweet it out now. I'm going to tweet out the probability link right now. And for those of you that are catching this on YouTube, you'll see it in the link in the description below. So you'll just click on that now and you'll be able to see it. I'll put Fed rate hike probability. And that is going to go live right now. So that was just tweeted out, if you're curious to see that. The where people are putting their money, not their mouths, is where there's going to be no hike. So it seems very strange to me. The Fed, in their last statement, by the way, took out the language about the kind of the global concerns that I've been really that they had championed so much in Yellen's speech. But we know that Brexit is still on the table, and we know China has not been doing well. I think that Yellen, when she talks about the global risks, must have a chart of FXI up. If it's going up or flat, she's no big thing. And if it's going down, she seems to get a little bit more nervous. And it's been going down, so she should probably be a little bit more nervous. Someone asked me about, I'm just going in order, POC, the point of control. When I talk about the value area high, value area low, and point of control, these are all market profile references. And the point of control is just the time price opportunity, the price basically where the most volume took place. There's two ways of measuring it. One is by volume, and then there's also the time, meaning the length of time you've been there. So I usually go by the volume one, but if there is a very prominent one with the time, I often note that. The value area high and the value area low is just a compilation of those numbers. It's basically the value area in general is where 70% of the day's volume took place, and you have the high and the low. These are all mathematically calculated numbers. I have a separate set of proprietary numbers I often talk about, like you'll often see me talk about prop numbers, and those are just observations I've made where there have been either support or reverse or resistance, really. With regard to the market today, I was watching SPY. It's been trading really. Someone was asking me if the OTF, that just means the other time frame. I've been trying to think about how I would describe OTF to you guys. Really, anybody who isn't a day trader is considered the other time frame. But when I talk about it, I really mean institutional money, the big boys. And were they involved in the the selling that was happening today? To some degree, there always is some OTF involved in the market, but whether the OTF is kind of running the show or not, you can really see by the character of the selling and by the internals. Do you have flashy action with big spikes up and big spikes down? That is not characteristic of the OTF. That is more characteristic of short-term traders, day traders, swing traders, and so on and so forth. I don't want to minimize those people. Some of them can be quite large. When you talk about like hedge funds and stuff, I would say that they usually would probably fall into the line of more the day kind of time frame, maybe swing time frame. I guess you could lump some of them into the OTF, but when I'm thinking OTF, I'm thinking like Prudential, like these big pension fund type of people. So that's what I mean. So the reason I would say that the market is still being controlled by short-term money is that the high of day that we stopped at 2 days ago when we had that big rally was the key support of the Fed day, the 2079. What was this? 75? The bubble covered it. 2079.75. I had that ticked off basically to the tick. Yesterday stalled just under the Fed low of day, which was the 2077.5. And then today we basically held the reference supports areas that I have written down of 2049. And we were moving in a kind of a cascading type of fashion on rather mild breath. When you have OTF buying or OTF selling into the market in the traditional sense, it's not this like cascading effect. It's sort of they do a little selling, they wait, they do a little more selling, they wait, or they do a little buying, they wait. It's sort of stair-stepped up and stair-stepped down with terrible internals, like 1,500 or better to the to the downside or to the upside, and like 5 or 8 to 1 positive or negative breath. And today at the worst, it was maybe 3 or 4 to 1 to negative. I always say 5 to 1 negative is sort of the vestibule to trending days. And I would say that today was definitely not a trending day. I mean, we were trending in the morning. We had usually there is at some point in an OTF day a bit of a rally, but then you tend to close on the dead lows. We didn't. Look at where we also stopped. Take a look at SPY for a minute. I want to just pull up the SPY chart. We stopped just ahead of the 50-day moving average. We filled the gap from 412. Actually, we had filled that gap. Not the one from 412. What am I talking about? Although that was the same levels basically. We got to the gap from 5.9. We filled that. We got a little bit lower. I had said that the key levels today that I were watching were 205.89 to 205.23, and the low of day today was 205.37. So we were right in that pocket. As long as that held, I was sort of okay. I'm not going to get too bent out of shape bearish. There are a couple of points here, a couple of nuances that I want to address. First of all, I love when followers send me stuff that is well thought out, and I've been getting a lot of it lately, and so thank you guys. Some of you have definitely been pointing stuff out that maybe I would either miss or have not looked at, or maybe looked at and not admitting that I looked at, that I wanted to give you guys credit for. But in the other day, there was an instance where somebody sent me something, and they were asking, were we going to have the same type of a reversal off trend as, I forget which other, I'm just looking where we were. And I had said it was possible we'd see the pullback for the gap fill, but something I didn't mention at the time was a little bit different this time. When we had the downtrend touch that last time, I think they were talking about 12.16 and 12.17. If you take a look at those two, those candles, that was a big up and then a right back down. The thing that was different this time was that time it was coming from a lower low and made a lower high. This time we were coming from, yes, a lower low, but made a higher high. That is a very subtle difference because it did take out the 5.2 high to get to the downtrend. So you can't say now that the market is making lower highs and lower lows because it just made a higher high on this leg than the previous kind of bounce. If you are looking at the reversal bars from 428, yes, you can say it's a lower high. I am a little iffy about saying that. It's still to be determined. This is a subtle nuance here. I don't like that we closed. I said I would have liked to have. First of all, when you have a reversal hammer day like we did, that's just a long tail. Usually, for it to be bullish, it needs to close green. We did not close green. We did, however, close the low of the prior day was 206.50, and we closed at 206.56. So we did technically close as an inside day. I am a little iffy in the fact that we didn't close above a key area that I have marked off as a proprietary level of 206.76 and the gap up low of day of 206.64. I know these are just numbers, but I'm just telling you we closed just shy. Sometimes trading is a game of inches. We closed just shy of where we really I would have felt a little bit more on terra firma. So it's now still a little bit of an iffy day. We did close above the 10-day. Like I said, we did close inside of range. It's a little inconclusive. That isn't where the inconclusive mystery ends either. It actually deepens quite a bit. This is something I really I want to draw some major attention to. Take a look at the curious case of Apple. I've been pretty bearish on Apple, but I did try a long yesterday intraday because I saw a lot of bottoming tail hammers in this area, and I was thinking maybe we were going to get a poor low and get a run to the gap fill first. But I was willing to take the chance because it was a very small, the risk-reward was good. Just because a risk-reward setup, by the way, is good doesn't mean it's going to work. When I talk about right or right out, I get stopped out a lot on those trades. I try to keep the losses as small as possible. Once in a while it gaps in your face and you have to risk manage that. And then we deal with gap rules with 5 and 15-minute highs and lows. That's a whole other ball game. Apple happened intraday when it worked up fine. I will tell you this. We had a break of the 91.85 to 92 area. It closed fairly weak today. I'm guessing Apple, it is bombed out stochastically. We had a lot of volume today. However, it wasn't enough volume in my opinion. I think Apple, there's two ways now I see of trading Apple. One is assuming you want to play if you want to play short, you can use today's high of day as your stop. Conversely, if you want to play long, you could play over today's high of day as a long. That is actually a screaming long, particularly if it happened tomorrow, because today would have been a look below and fail, a fake breakdown. I don't know if that's the case. I don't think it's the case, but it could be the case. I'm always open to those things, and I'm not dogmatic. I just go by the levels. The other way is to see Apple come down to somewhere between the 61.8 and primary trend. If it were to happen tomorrow, that's roughly 85-ish. The 61.8 is 85.72, and the trend line is roughly a little bit below there. It's 84, I want to say 75-ish, in that area. So I think that is where we could be potentially going. If Apple wants to retrace all of the gains that it's had, that would take you down to roughly about 75. I know that sounds crazy, but it's, believe it or not, more possible than you may believe. I don't think that it's going to be a straight line. I do think that there'll be some sort of false dawn moves. I've seen, this isn't my first time at to the rodeo with Apple. I've seen when it's in a bearish cycle. It's a little less conclusive at the moment here that it's that it would make that big full retracement. I think that there will definitely be a long right or right out trade down there in those like 84s, 85s, or back up over today's high of day would be a long in my view. Here is where the inconsistency comes in. When you look at the Qs, you have Apple that quote unquote, not quote unquote, it did break down today. The Qs did not. Apple is a huge component there. The last swing low there was 104.40, and today's low of day couldn't even snap 105s. If you've watched my videos for a while, I have talked about this 105 level, 104 to 105 level being super duper key for a various number of reasons. Apple did closed worse than the Qs. I would say that should have been much worse. The Qs should have been much, much worse. With regard to the VIX today, as scary as it was like barely up today. You got into the 15s, and then today it actually closed negative. The VIX closed down. S&P closed 0.06 higher. There's a lot of divergencies here. If the market were to really kind of want to fall out of bed. That is a little odd. Like I said, the breadth wasn't that terrible. The ticks, if you look at the ticks, we had one minus 1,000 tick. All the others were in the 900s or 800s. That isn't symbol of panic, just get me out at the market order type of selling. I would say so how do you interpret that? Is that bullish or bearish? I would say it's indicative of this low conviction market of, shorts not having a lot of confidence and bulls not having a lot of confidence. This is just sort of more of this choppy slop. There is no capitulation, though. If you're this is only day 2 of a potential, market peak where we have a sell-off. It would not be capitulation, and the market could go, if we took out today's low of day, I think we can go significantly lower. The 204s have been rock solid support. It's been tested multiple times. The last test was a 50 MA test. Today was basically almost a 50 MA test. I will be a little more I would think that tomorrow is probably a long over today's high of day, and maybe a short below the low. All right, Sally sells seashells by the seashore, right? A long over the high of day and a short below the low of day. Very, very simple. I'll leave it at that. Yeah, I feel comfortable with that analysis there. Facebook, still the standard bearer. That's also, by the way, another reason you knew the OTF wasn't in the market today. You had Amazon up, you had Facebook up, you had a lot of names up. When they are coming for them all, and it's one of those helter skelter, Katie bar the door down days, nothing is spared. There's no higher in Amazon, there's no higher in Facebook. It's all just sell across the board. That also tells me that today wasn't an OTF selling. These guys don't really look at the technicals like you and I might. They just know that they have X amount of shares they need to sell that day, and they give it out to their brokers to scale the orders, to handle the orders. That is how the market really works. Very key to know that. Any sector you like or dislike in particular? Yeah, I don't like the IBB. Someone asked me about let's get to that in a minute, though. So, what happened yesterday? I think what really nailed the market was that we got to the downtrend line, and you got this blow up in a couple of major stocks, in Disney and in Macy's, and then tonight after the bell, you have some follow through in Nordstrom's. Retail is getting taken to the woodshed. I will tell you, I had to get something for someone for Christmas. I went into Bloomingdale's, which is owned by Macy's. The selection was shitty. They were overpriced, and they had incompetent staff. I had to buy because I had to give, I was one of those late type of gifts. But I will tell you, Amazon is so far superior of a customer experience, or buying on any online site or even apps on your phone. It is so far superior to dealing with people in stores. And I think that sentiment is just going to keep getting worse and worse. Think about all the jobs that have been created. They've all been in restaurants. They've all been in retail, a lot of part-timing. Retail is going to be automating. A lot of it is going online. I'll tell you, a ton of these stores, by the way, it hasn't been announced yet, but this is my kind of big prediction. They are going to start closing a lot of these stores, and they are going to start laying off a ton of people. That is going to not do very well for the employment situation in the country. So keep that on your radar. That's a little something to keep in your back pocket. Same thing is going to happen with restaurants. I gave the story that I was at a late night movie. I came out, I went into Pizzeria Uno, and they had an iPad wannabe on the table, and at the time you could only order appetizers. I asked the manager about it. I was very fascinated about this. He told me that they are going to start having servers only, basically, and you will be able to order your entire meal online. Have you ever gone into a CVS lately? They have like one person behind the counter, one to and then one to MC the self-checkout. In my neighborhood, there's like all self-checkout. You're lucky if you could find anyone in that store. So seriously, this is really happening, and this is going to change the world in a way that we have never seen before, and it's never coming back. It's just going to be automation. That's it. I was watching The Matrix last night for a little bit. It was on TV. And Terminator. This is, we all know how this ends in the end, but first they're going to scorch the job market. So that's that. The dollar. All right, so a couple of things I've talked about. The thing that's been holding the market in, we know all the economic data is junky, is that there is a PE multiple premium being assigned to even these junky earnings because there's sort of nowhere else to go. I think this was Leon Cooperman's argument at the Sohn conference or one of these events. By the way, speaking of that, I love how these guys, these big hedge fund guys, are able to come on and talk their books. If I were a hedge fund guy and I was playing and I knew I was going to be on TV and give an idea, I know stocks are asymmetric and I know I'd get more bang for my buck with a short thesis, I'd come on and give my short thesis. Of course, they're already short, and then they benefit from your panic, so to speak. So that's that. These guys are all usually a bunch of misanthropes anyway. I know a lot of them, believe it or not, in my personal life. You'd be surprised more often than not how many of them consult me on levels and what I think about things. These are guys that run major amounts of money. It's actually quite crazy. It's also really alarming if you'd ever know how little some of these guys really know about the markets and options in particular. It's quite alarming. But anyway, the point being is that they're always negative, and a lot of these guys are super duper shorted up, and of course they're talking their books. Anyway, back to what I was saying is that the market has been getting a PE multiple premium because of the bonds, the interest rates. Take a look at TLT. I had that double bottom, and it just got a trend touch yesterday, and today it didn't. The back off was rather minor. I'll tell you, it really is puzzling to explain how Coca-Cola is trading 27 times earnings. It's because they have a 3% dividend, and if you go into your bank, you can't get very much in terms of return from CDs or on anything. So that's why these stocks have been up for so long. These are perceived as safe plays. I assure you, when this bubble ends, these are going to end very, very badly. I mean, these stocks should be trading at, maybe low double-digit PE multiples because they don't have a lot of growth, but they're getting assigned higher than normal PE multiples before their dividends and just because of what the market is. So everyone knows this, but they leave out this one point. This insanity can last a lot longer than you can stay solvent short. This can go on for years. Yellen talked about not seeing the 2% inflation amount for maybe 2 years. If they don't hike for 2 years or they hike a quarter of a point a year, I mean, these stocks are going to stay at a huge premium for higher for longer, as long as they stay lower for longer. Speaking of lower for longer, let's talk about inflation. I don't know where these ivory tower Fed heads shop, but I'm on the email list for Banana Republic and Gap, another bunch of these guys who blew up on earnings recently. Every day I get 35 to 50% off coupons. Prices of clothing products are coming down. Is that inflationary or deflationary? That's another deflationary sign. Gas prices, as we know, have been coming down quite a bit, although they've been up a bit lately. When prices are coming down across the board, that is known as deflation, not inflation. So I don't know what the Fed is talking about. I will tell you this, and this is an anecdotal thing. I happen to pay a lot of attention to this. These are things that, this is what goes on. This is how I think. I remember in the heart of the crash in 2008 and 2009. I remember I was on vacation once. I was in the Breakers. It was a ghost town. I remember I was at Bloomingdale's one day, and it was a ghost town. And I remember in particular Banana Republic, because this is actually a banana shirt, believe it or not. I buy a lot of stuff there. I happen to like their, it's low price, and it's, I don't get too upset if I spill tomato sauce on it. So the Gap, anyway, not the Gap, Banana Republic. So they were discounting a lot of stuff, a lot of their clothing. So much so that they have trained their customers to never pay full price. I will never pay full price in that store, ever, never, ever again. I wait, they send me a 50% off coupon once or twice a year. Usually they're limited, but they do it once or twice where you can buy everything. I load up, and then I don't shop again for the entire year, maybe 2. So they have trained their customers to be thrifty, to look for discounts. They've gotten better with their price strategy, where now they overcharge for things. So when they mark it down, it's not really 50% off. It's really like 15% off. I mean, no one's paying $130 for a premium sweater there. So if you wind up getting it for like 80 or whatever, you're probably basically paying about full price in that instance. But a lot of the instances, they do the markdown to the markdown. The stores are not doing well. The online, I guess, is probably doing a bit better. They even now offer things online that they don't offer in the stores, believe it or not, because of inventory issues. I think this trend is here to stay. But the point being is that customers, people, particularly I would say, I'm already an old man with regard to this, but with millennials, they have grown up with smartphones. Even the generation, the new millennials, I don't know, even younger than millennials. They have grown up with smartphones, they've grown up with Amazon, they've grown up with Google, and they are shopping. Usually, back in the day, if you had to buy a shirt, you go into Bloomingdale's, maybe you look in Saks, and you're done. Now, you can go online and you could find the same shirt, anywhere, or even better. You have so much, the consumer has never had so much access to technology and the ability to shop or to find product. It's absolutely astounding, and this is never going to change. And I think the technology has just moved faster than the economy can catch up with. And when people are trained for jobs that are no longer relevant, it is called structural unemployment. There are the ebbs and flows of the business cycle, which is cyclical employment, which is what the Fed is very good at combating. Their nightmare and what they are dealing with is a structural change, and we are in a cyclical downturn within a structural downturn, which is kind of the worst it doesn't get any worse than that. So that's the story. That's really the truth. And I don't care what these, jackasses on television tell you. This is really the truth, and this is not going to end anytime soon, and it's not going to end pretty. So that's that. With regard to the dollar, that to me was a really big headwind for the markets, and now it's sort of, I guess it's been a tailwind the last few weeks. It looks like it's catching some footing. I've been talking about UUP. I talk about this bracketed range. Moves above the range have been more sticky than the moves below, although now the moves below are starting to get a little sticky. As long as the dollar today was, yesterday it had a bit of a reversal. Today it was back up. I'm a little cautious with the dollar. I think as we move into I think people are so offsides positioned for the Fed, assuming they're not going to hike. Excuse me. That there has to be some that comes back, some premium or some probability that comes into the Fed hike, particularly with these Mesters and Esters and whatever's talking their heads off. So my guess is you might get a bit of a rally in the dollar. We might get a bit of a rally in the dollar. That could be trouble for oil. Have to keep an eye on that. Although I've been bullish on oil, I still think we're going to see the 49s. Today kind of held up. We had made a bit of a new high. It backed off a bit. We still closed above the high of day. Listen, it's just consolidating here. I think that we could have some pullbacks in oil, but it could go higher. I think the tell also, and this is a mistake a lot I've made before, and I've realized and I don't make it anymore, is you got to watch both oil and Exxon. If Exxon is up while oil's down, the move in oil down is probably punk, and it's probably going to reverse, or it's not going to be so bad. If you get oil down big and you get Exxon down big, you have more of a problem. So if there's any divergence in those, and I remember yesterday I saw some TV reporter talking, oh, Exxon's down. It went ex-dividend, for crying out loud, and I think the stock wound up still closing up a little bit. Stocks are supposed to go down by the amount of their dividends. So that if there was any divergence yesterday, it was because they went ex-dividend. Eesh. So any sectors I don't like, someone asked me about. And the sector that I have not liked for a while is IBB. Why? And we're going to end on this because I have to boogie. So why don't I like IBB? One, it looks like a really disgusting pattern. It had a head and shoulders breakdown, a check back, another breakdown. It was looking like it was trying to break out. This was back when it was in the 341s. Came back down. This is starting to look like the leg 3, I guess, of the 3-leg wave. This could be kind of the final countdown washout. We'll have to see. There are some reference lows in the 240s, given where it came from. A lot of people see, oh, we came down to 240, so of course we're breaking down. But they forget that this breakdown started from 289. And it's basically come down in a straight line with maybe a day or two bounce. So it might not break initially, and if it does break initially, it could be a false breakdown. You have to be careful. I would love it to come down to 240. Spend a bunch of time down there, like Apple did, for example, and then crack. Or come down there, have a bounce to a lower high, and then take it out. That would be absolutely a disgusting pattern. I think IBB, the problem for them is Hillary Clinton, Trump, and Bernie Sanders, all the three potential presidential candidates, although I'll tell you at this point, if Hillary isn't indicted, it's going to be Hillary Trump, and that is the show. Holy cow, that's going to be great. Anyway, the two of them both agree, so you're probably going to get regulation in drugs, and they're not going to be able to charge as much. That hurts margins, which hurts the profits and the bottom line, and that means lower PE, higher, believe it or not. The margins are going to go lower, and the PE multiples, which all seem so cheap here, everyone talks about Gilead only being 7 or 6 times earnings. If they are not going to be able to make those earnings, that PE multiple is going to go way up, or the price of the stock is going to have to come super-duper down. Speaking of Gilead, this basically got back, look, it was at 103. It came down to the 81s today, and it had a bit of a bounce. It's bombed out stochastically. You might get a couple of day rally in this, but this is do or die levels, and this is the big, these are the big boys of biotech. So I would keep an eye on Gilead if you want to play long over today. short below the low today or long over today's high tomorrow, you'll probably get a few days of rally. These days, you might only get 1 day of rally. Who knows? But that's how I would be playing Gilead. Keep an eye on this. Anyway, I think that, with regard to IBB, where I think it could go, how low could you go? The whole Michigas here started from 207.48, a 1.618 Fibonacci extension. I think I did this from the flash crash, from the peak to the flash crash low. Would take you down to 212.08. So somewhere in those lower 200s are probably where this could end. We are at a really key area right here. And that's assuming you lose 240s. If 240s hold and it's firm and we come back higher, that could be the end of it. And it could be. I mean, Gilead is right at the low, and if that is the double bottom low, we go back up, it's possible. But I am not such a big fan of the situation. I think there's a lot of headline risk, and I really do believe in the peak earnings thesis. I should, because it was mine. It's been copied many times, but I was the one who started it, along with lower for longer, but who's counting? Anyway, that's my story. I'm sticking to it. Again, if you're not following me on Twitter, my handle is @JustinPulitzer. If you missed part of this broadcast or want to watch it again, I know I'm handsome, it will be on Justin Pulitzer Trades on YouTube. Anyhow, that's my story. I'm sticking to it. I will see you guys or you won't see me, but you'll hear me on my Sunday night weekend review. Like I said, keep an eye on today's range tomorrow. Anything below the lows could probably and most likely will get squirrely, assuming it's a 50-day break. Anything above the highs, I think we will go up. Cheers.